Aleph Zero is the perfect cryptocurrency to ride those waves. It has gone up more than 100% several times in the past, but it has also dropped 50, 60, 70% several times. So you get very nice waves to trade. Look at this, a 260% rally in a matter of 2-3 months. Another 140% rally, and here at the beginning of the year, a 126% rally. But here's the problem, right? There are these massive crashes in between as well. What's the best way to time this? I think there are two very nice approaches for the Azero token. First, we can look at the relative valuation to Bitcoin, see if this is in a more stable trading range, which it is. Second, we can look at moving averages. This here is the Azero token simply in US dollars. But look at this relative to Bitcoin. That's the same chart but measured in Bitcoin. And here we've got nice supports and quite steady resistances. Look at how those two peaks align very nicely on the Bitcoin denominated chart, but how they are very far off on the US dollar denominated one. Also here the support gets hit 1, 2, 3, maybe 4, 5, 6, 7 times, depending on if you want to count them or not. On the US dollar denominated chart, the support here is a pretty strong breakout. So this is method number one, and this would of course imply a quite nice rally. Not too much risk, maybe another 7% or so downwards pressure versus Bitcoin, but a very nice potential rally. Maybe an outperformance versus Bitcoin of 111% or 167% even, if things turn really, really bullish. But why does it make sense to look at relative valuations to Bitcoin or maybe Ethereum in the first place? Why not just look at the US dollar price? There's two reasons. The first reason is there are normally movements within crypto. So sometimes crypto A is very popular, sometimes crypto B is very popular, and so capital shifts within the crypto space across different altcoins. And so you want to ride those waves. When you divide by the Bitcoin price, you take out this general macro trend. Right? The overall crypto space might be expanding or contracting depending on how much current attention there is on crypto. When you divide by the Bitcoin price, when you divide an altcoin price by the Bitcoin price, you take away that general expansion and contraction. You just look at those shifts within the crypto space. That's reason number one. Reason number two is that whenever you get into an altcoin, you take on more risk than by just buying Bitcoin, for example. When you take on more risk, you should be expecting more return, right? Why else getting into more risk if you don't expect more return? So by dividing by Bitcoin, you can see, does this risk that I currently take get compensated for? If it doesn't, if I just make 10% gains, whereas Bitcoin makes 15% gains, then it was a bad investment to get into the altcoin. So relative valuations to Bitcoin for that second reason also make a lot of sense. And the chart also here for Azero confirm this, right? There are these movements within crypto when sometimes a certain altcoin is popular and sometimes it isn't. Currently, Azero isn't too popular. We see these kinds of sideways trading ranges, these bound ranges for a lot of cryptocurrencies. So they are very, very useful. You can either divide by the Bitcoin price or you can divide by the Ethereum price. Both are viable options. The correlation to Ethereum for altcoins tends to be slightly higher than for Bitcoin. So dividing by Ethereum, even though it's not as common of a practice, is very much viable as well. The second approach, which can be used for any altcoin, but also here for Azero, is to try to follow trends. So instead of now catching that knife, because we are relatively low in relative valuation to Bitcoin, instead of buying this now low when we don't yet know if we are turning around, we can wait for the positive trend to establish and only then buy back. So you're following the trend is your friend, and this usually works in crypto pretty well as well. A common way to trade trends is to follow moving averages, either the simple moving average or the exponential one. Here we've got one of those moving averages, the 200-day, and the idea would be that you get out of the asset, or you even bet on falling prices whenever the price is below the moving average. And you bet on rising prices whenever the price is above the moving average. So you're bullish during this period, make 20% gains, and you're bearish in this period, betting on falling prices while the price went down by 33% roughly. The question with that approach is always, what's the best moving average duration? Because this is now the 200-day. But maybe instead of taking the 200-day, the 100-day would have been a bit better, right? Because here we would have entered much earlier, we would have exited much earlier, 55% gains, and then we would be betting on falling prices when it crashed already 43%. So maybe 100-day is better. But what about taking the 50-day? Is that maybe better? What about the 25? What about the 10? This is where it becomes a bit more complex. This is where we now need backtests. We need simulations of buying and selling the token, trying to find out what's the best moving average in the past. And the fundamental assumption here is that whatever worked in the past continues to work in the future. So the trends, the momentum, the psychology of the market doesn't change that much over time for that asset. That's the idea. So for the backtest, to find the best moving averages, I've taken data that starts in January of 2022 and it goes all the way to October of this year. I've then run a macro doing all of those backtests for different moving average durations. Buying and holding over the time would have given us minus 36%, unfortunately. And here's the annualized returns for the simple moving average and the exponential moving average. And once we get a bit longer in duration, the moving averages tend to outperform just buying and holding. We also have this in chart form over here. So in black is buying and holding, would have given us minus 36% annualized. In turquoise is the annualized performance for the simple moving average, and in red for the exponential moving average. Yeah, on the x-axis is the duration of the moving average. We can see once we go beyond 110 days or so, we tend to outperform very well just buying and holding. We turn band and we tend to outperform buying and holding here, this black line, quite nicely. The best simple moving average is over here, the 161 day. The best exponential moving average is any of the ones over here. Let's take the 132 day, the earliest. So we have two very different durations. Let's plot them on the chart. So again, SMA in turquoise, EMA in red, and we have not yet turned bullish, right? We're still very low in relative valuation, but also in US dollar valuation. And in order to follow a positive trend, we have to rise at least another 14%, better another 17%. So both of those moving averages are falling. So every day this is good for us, right? We can cross this easier and easier with time. But currently, at the time of this recording, the trend really can only be seen as reversed once we cross the 90 to 93 cent area. Now we are at 79 cents roughly. So yes, we are low, especially relative to Bitcoin, which could be an opportunity, but so far people are not yet picking up those low prices. If we take the approach that historically timed those trends the best, with the best moving averages, we still have to go up quite a bit from here. Let me know what altcoin I should backtest next. Join our Telegram, link is down below.